We are going to talk to Radar Logic's CEO. The composite index that the company put together increased by over 1% in April. The month-over-month increase in the index may be a signal of seasonal price gains, which we haven't seen since the onset of the housing bust. Joining us now is Radar Logic's CEO, Michael Fader, to tell us more about the RPX monthly housing market report. Michael, thanks for joining us. Is this a positive sign to see this? I mean, especially when Kathleen is talking all the time about how we need to see affordability come down or affordability rise, prices come down so that people can get rid of the excess inventory in the market.
I think undoubtedly, Matt. People forget several elements about housing. One is the seasonality. We're into the period of time in which we would expect to see people buying houses. This time last year, we did not. Here, clearly, we've seen a return in most of the country to the patterns you'd expect to see this time around. Remember, housing prices, the composite, our 25-city composite, is off still over 30% from its peak. Maybe that's enough of a reset to get people back into the marketplace. There are two things to be cautious of. One is affordability, as Kathleen points out, is a key issue. Will people believe that they are earning enough money and will continue to earn enough money to afford going out and buying houses? The second is, and this is where we're a bit of a departure from traditional housing indices, the Radar Logic RPX numbers are really a spot market of value. This appears to be a bit leading as an indicator in terms of economic response, as opposed to housing starts, permit starts, completions.
Just on cue, we're looking now, of course, at the index. It's the level of the index, and it's the level of GDP. It's not the percent change. And if we track the orange index, which is your home price index, Radar Logic, versus the blue line, GDP, we see peak in the home prices before the peak in GDP. That's your point.
Well, it is very much part of the point, Kathleen, as you and I have discussed. We believe that what people perceive the value of their home to be is very important in terms of their sense of confidence, consumer confidence following their perception of individual wealth. The RPX price being, if you will, the spot price at which buyers and sellers agree on home prices, translated to a single price per square foot, is a good measure of that. It is likely, if in fact it's a confidence component, it is likely to lead consumer sentiment, may lead retail sales, may ultimately lead GDP.
What do you think about house prices in relation to the amount of money that people earn? Because obviously people are concerned about that right now. I was actually talking to some people at Ned Davis Research yesterday. They said right now the median existing home price is about 3.6 times household income. It seems still a little bit high compared to what you would expect for historical averages.
Well, interestingly, Matt, prices as we track them are down in California, for example, 50% from their peak. So if it seems high now, imagine how it felt to people 2 years ago.
Well, the whole state's going bust.
But wait, that's what I think one of the most interesting findings in the report. Each of the 5 California metropolitan areas posted their largest month-over-month price increases since April of 2005.
That's right. There's no question that the price resets in houses in California, which were probably triggered by the massive amount of foreclosures and the motivation of those financial owners to sell those homes and drop those prices and move that inventory, the buyers are back. Remember, if people don't feel that they can afford the homes, they're not going to buy them. If they don't buy them, we don't see any numbers, and we're seeing the numbers, as Kathleen points out, looking stronger than they have in the last 4 or 5 years.
Are inventories now, at 10 months and change, is that the new norm? We just talked with David Malpass about the new norm as far as growth, the new norm as far as inflation expectations, et cetera. Is that, do you think, a new norm? Do we live with this kind of inventory for a while?
I honestly don't know, Matt. I think inventory levels are a critical component as to what happens in the housing markets as we go forward. If that's the new norm, so be it, but that'll have a clear impact on home builders and building material companies. The historic norm, of course, is about 6 months. We're down from a peak of roughly 12 months, but 10 months is still a lot of inventory, and there may still be foreclosures to come.
Quickly, in Olympia, Washington, where I grew up, it's the bottom part of the market, first-time home buyers taking advantage. None of the upper-end homes are moving, but in Miami, you saw a mix of transactions towards the expensive zip codes.
It's very interesting in Miami, and there are a couple things to point out about the Miami numbers. One is that the actual volumes are down to the point where the component of the volumes that we're seeing may in fact be a bit distorted. But yes, what we saw was an increase in the activity in the top quartile by price per square foot, which happened to correspond, if you will, to the oceanfront condos.
Hey, Michael, it's been a pleasure having you. We should definitely do this more often. Michael Fader there, CEO of Radar Logic. Kathleen, thank you very much as well. Got another plug for Olympia, Washington, which is good.
You know.
The capital of punk rock girl bands.
And real estate. Go look at houses there. Good.